I'm Jane Sluzark, and I lead global communications at Principal Financial Group. Over the past year and a half, I have led a team to develop a unique research initiative that adds greater dimension to the topic of financial inclusion. According to the World Bank, 1.7 billion adults are excluded from the formal financial system due to several factors, including infrastructure, education, literacy, and public policy. Almost one third of the world's adults are struggling to escape poverty and improve their lives. Macroeconomic and demographic shifts are accelerating the need for greater financial inclusion. Higher commodity prices, rising inflation, and growing income inequality are just a few. Financial inclusion is an enabler and driver of economic growth and resilience, improved financial health, job creation, and development. The United Nations identifies financial inclusion as a key enabler of several of its sustainable development goals. These are aimed at ending poverty, protecting the planet, and ensuring prosperity for all. It's not a new message. Greater collaboration is needed across all sectors to develop more informed, sustainable solutions. Through these initiatives, we will all be better positioned to prioritize financial inclusion on a global scale. As a global organization focused on helping more people, businesses, and communities access financial security, Principal believes the best way to make progress is to examine the challenge more closely. So we commissioned the Center for Economics and Business Research to develop the Global Financial Inclusion Index, a robust measurement framework that tracks financial inclusion across 42 markets, examining the roles of governments, financial systems, and employers. Using a mix of public and proprietary survey data, the index identifies structural gaps and provides insights into how we can address them. In September, we released the inaugural report. Today, I want to walk through a few of our research highlights and spend time exploring some of the ways technology influences financial inclusion. The Global Financial Inclusion Index consists of three pillars: government, financial services, and employers, each selected due to the significant role they play in financial inclusion. Each pillar is underpinned by hundreds of public and survey-based data points. For example, in the government pillar, some of the indicators we include are consumer protection regulations, education and employment levels, the availability of government-provided financial education, and online connectivity. Within the financial system pillar, we review data on real-time transactions, access to credit and bank accounts, and the presence and quality of fintechs. Within the employer pillar, we look at how businesses provide financial guidance and support, employee pension and retirement contributions, and insurance benefits. On the right side of the slide, you'll see the 10 markets that scored highest for financial inclusion overall. Singapore tops the charts, thanks to strong government and financial system scores. They're just barely ahead of the United States, Sweden, and Hong Kong. Unsurprisingly, markets with greater resources and developed economies tend to lead the index. Emerging markets tend to land lower in the rankings. What's perhaps more notable than who is in the top 10 is who is not. Large European economies, such as the United Kingdom, Germany, and France, lag behind their Nordic neighbors. This is due in part to an over-reliance on the government and financial system pillars, and a lack of engagement from employers. Turning to Asia, you see a range of financial inclusion scores. Singapore and Hong Kong are in the top 10, while Indonesia and Vietnam rank 28th and 30th, respectively. Lastly, Latin America and Sub-Saharan Africa are the index's lowest ranking regions, with Argentina ranking 42nd. The index, however, is about so much more than just the rankings. There are several key takeaways that we glean from this research. For example, we found that a balance between supportive public and private sector engagement is critical to financial inclusion. Over-reliance on one pillar and neglect of another is a difference maker. Typically, we see markets with strong government and financial system scores having a lower employer support score. These are usually developed markets with greater resources at the state level. This is likely what has led markets like the United Kingdom, and Germany to land in the middle of the rankings. On the other hand, markets with strong employer support scores tend to have lower government and financial system scores. This shows up mostly in emerging markets, where there are fewer resources at the state level and more employers are stepping in with benefits like retirement contributions and insurance support. The only developed market that scored in the top 10 employer support pillar was the United States. It's an outlier due to its heavy focus on private sector involvement and the primacy of the employer on everything from health benefits to 401ks. Lastly, the significant role of employers was validated throughout the index. However, an area to watch is that larger businesses usually provided more support than smaller, and full time workers tended to get greater benefits than part time workers. As a part of the index, we included a few digital and technology related indicators to better understand how these innovations can help drive greater financial inclusion within a market. Specifically, we looked at online connectivity, the presence and quality of fintechs, and the volume of real time transactions. Markets most commonly receive high scores for online connectivity and the presence and quality of fintechs. Online connectivity is measured by the number of fixed broadband subscriptions per 100 people and the number of mobile cellular subscriptions per 100 people. The presence and quality of fintechs looks at the prevalence and effectiveness of companies using technology to support or enable banking and financial services. The volume of real time transactions was the lowest scoring digital indicator for most markets. This indicator looks at the use of electronic payments on a per capita basis, and it's important as these transactions offer additional transparency, enable better cash management, and improve liquidity for people and businesses. Now, let's explore which markets ranked best across these digital indicators. First, online connectivity. Hong Kong ranked first in this category, followed by the United Arab Emirates and Thailand. For the presence and quality of fintechs, Israel, the United States, and the United Kingdom rank highest. They've embraced digital innovation and invested in the sector as a growth area. Denmark, Thailand, and South Korea tie for first for their volume of real time transactions on a per capita basis. At a high level, digital finance is equipping people to smooth their consumption, allowing them to save for rainy days and invest in their businesses and families, all pushing income potentials higher. The Global Financial Inclusion Index identified multiple links between technology innovation and financial inclusion that correlates to economic success. Younger, vibrant economies tend to score very well when it comes to accessible financial technology. These markets include Singapore, Hong Kong, the United Arab Emirates, Thailand, Malaysia, and Saudi Arabia, all which score quite favorably on our digital indicators. Hong Kong, the UAE, Thailand, and Singapore all rank in the top 10 for online connectivity. Singapore and Thailand appear in the top 10 for real time transactions. Singapore ranks fourth and Hong Kong 13th for the presence and quality of fintechs. In many cases, emerging economies are outpacing or leapfrogging older, more mature economies in financial technology adoption. Through this research, we hope to inspire action that helps build greater financial inclusion around the world. First, there is significant opportunity for the financial system to embrace the creation and adoption of financial technology. This could help better connect people with the financial system by being more responsive to the unique needs of a market when it comes to financial support. It will also bridge a perceived gap we tracked through this research that people don't feel as if the financial system is providing the support it should for financial inclusion to take hold in a market. Second, we must all further support employers in empowering their employees' financial progress. The 2022 Edelman Trust Barometer affirms business as the most trusted global institution, ahead of non governmental organizations, government, and the media. On top of that, 77% of global respondents trust their employer. This suggests that the employer employee relationship can be a strong driving force behind greater financial inclusion. Finally, in a digitized global economy, relatively modest investments in technology and financial infrastructure across all three pillars can generate significant and quick impacts, including the promotion of financial literacy, improving real time transaction volumes, and more. There are many reasons why financial inclusion matters, including helping communities and markets to be more resilient, to grow economically, and to weather financial shocks. We're very excited about the research and the promise it holds for providing best practices for global nonprofits, governments, and private organizations to help guide informed decision making. I invite you to dive into the data and insights further. Please check out the index resource link on this session page. Thank you for your time and your attention. And thank you for everything that you do to help more people feel financially included and secure.